Good morning, everyone. So this is the third part of our discussion for today on week number 11 on dividend policies and retained earnings, right? So we're talking about dividend payment and then what are the three dates that are important. So the three dates are those that are first is the holder of record. On this day, the company will be examining the books and then see who's eligible to be part of a payout for cash dividends. Now, that's the record date or holder of record date. So this is the one that you see right now. But of course, there is a cutoff, right? So a cutoff on who needs to be eligible because why? You might buy or sell like stocks in between those dates. So that's why they need to establish the holder of record date. So here also, there is what we call an ex-dividend date. This is actually a date before the record date. So what do I mean by that? So this is 2 business days before the holder of record date. And then this is basically looking at it as a cutoff date. Let me just move around my stuff so you can see it. And then you have the dividend payment date wherein it's going to be the date that people will be paying, right? So I'll just use a timeline for an example. A timeline will be, say, I'll start with the record date, March 6th. So the company will view the records, stock records, and then to confirm which shareholders are eligible, 2 business days before that, then that will be your ex-dividend day. So make sure it's business days, not calendar days. What it means is that you are not counting holidays or you're not counting also the holidays and weekends. So to receive the dividend, shareholders must own the stock before. So that's the operative word, before March 4, which is 2 business days before the record date. And then the payment date is actually when the dividend is paid to the shareholders. One important thing to note is that, for example, if you buy the stock on or before March 3rd, you will be eligible to, you will be on the record as a shareholder by March 6th, which is the record date, and then you will see dividends. But if you buy the stock on, on, or after March 4, then you're not going to be eligible. You'll be on the next cycle. That's why there are 3 dates that they need to establish. Who are the holders of on record or the record date? Then you look at 2 business days before. Anybody on that cutoff that have bought the stocks on that day, on before or on that date, then it means that you are eligible for the dividend declaration. And then anybody on that date and after would be for the next cycle of the payment. Okay, so those are the important dates. Now, we're going to go to the last stage of the discussion, which is like the stock dividend and then the stock split and also a reverse stock split, right? So here, let me just make sure we have. So the stock dividend is a distribution of additional shares to common shareholders. And then normally it's actually 10% range. Why? Because if it's too large of a stock dividend a declaration or distribution, it will be considered as a stock split. And why do we need to categorize between a stock split, which is actually about 20 to 25% or more, compared to a stock dividend? Because the accounting is actually different. We will have some slides wherein we're going to talk about the accounting side visually, so you can actually see the impact. So stock dividend, as the word represents, is not a dividend or an ordinary or like the normal dividend, which you pay in cash. Instead of paying cash to the shareholders, you're paying an additional stock. Okay? And then, for example, this is the financial position or balance sheet for X and Y corporation. And then this is before and after a stock dividend. So this is before and this is after. How does it look like? So before they declare the dividend, XYZ, you have a million shares at 10% par. And then so you have 30 million of net worth or total equity, which includes both the common stock, additional trading capital or capital in excess of par, same, and then retained earnings. Now, when it declares a stock dividend, say 10% stock dividend, so 10% of 100,000 share is actually 100,000. So it increased the 100,000 by 100,000. So it's now 1.1 million shares. Still, the par value is the same. On a stock dividend, the par value of the stock will remain unchanged. It's now going to be 11. But when you think about it, the capital in excess of par is actually 5.5 million, which is basically a calculation on the difference between um, the stock that was paid and then the amount received, and then also the par value, which is 10 par. And then you're still having your total equity is still 30 million. So it's the same. I'm gonna let me mark it so you can see it. So it's actually the same. So what happened? There is a reallocation between the common stock because you now have more shares by 100,000, and then a reallocation also of the capital, additional trading capital. Where's the difference? It all gets adjusted against retained earnings. So a stock dividend does not change the composition of the total equity. Okay, does not change the total amount of the equity, but it changes certain compositions because of the change in the number of shares. And then anything is adjusted against retained earnings. So that's one thing that we need to be aware of. So on what we have right now is that before the stock dividend, if you have the EPS is so the EPS, so what's the impact of a stock dividend with regard to earnings per share? So let's just do it this way. So assumption one, 1 million shares were outstanding before the stock dividend, and then 1.1 is afterwards, as we've seen a while ago. Assuming that the firm has an after-tax income of 6.6 million, so how does it impact? So 6.6 million is your after-tax earnings before and after the stock dividend. And of course, the shares outstanding is now different from 1 million shares to 1.1 shares. So what's the impact? Your amount of stocks or your EPS will be diluted. Diluted by when you look at the difference between 6.6 and 6, it's a 10% decline, and it's the exact same increase um, of your stock. So remember, we increased the number of stocks, or we increased the stock dividend. Sorry, we increased the number of stock by declaring stock dividend by 10%. That 10% increase in stock represents a 10% decline on EPS. So it's like equal to that one. Okay. So earnings per share have decreased by the exact same percentage as the shares outstanding increase. So that's the impact. Now, what about the market value? Like, did the market value change? We talked about a while ago. There is a reallocation, right? Same total equity reallocated to retained earnings. So let's go through the same example. Assume that, or a different example. Assume that stockholder A has 10 shares before the stock dividend with a 10% increase. It becomes 11 afterwards. So now without the stock dividend, it's the 10 shares, right? But with the stock dividends, it's the 11 shares. But remember, the earnings per share change is from 6.6 and became diluted, a decline by 10% of 6 after the stock dividend. But there you go, there's the but, right? Important. It's the same, right? So here, assumes the stock sold 20 times earnings before and after stock dividends. This is actually now the sale. Your shares is 10 before stock dividend or 11 if there's a stock dividend. If you're selling it at the PE ratio of 20, Price earnings ratio is mostly a multiple when you make the sale of a stock. And then if your EPS is 6.6 or 6, then it's actually basically the same. So it did not change the market value, unchanged. But it did change the EPS. So if the cash dividends, if so, the possible value of stock dividend is the cash dividends first remain constant at the time the stock is declared. Shareholder will receive greater total dividends. Now, because this is the good thing about a stock dividend, instead of getting only dividends in the future for cash, right, at 10, because you have a 10% increase in the stock dividend, then any cash dividend declaration will now be based on 11, an increase in the number of stocks that you have. So it's good for you when you have cash dividends after a stock dividend has been declared. Because why? You actually have more base to multiply with the cash dividend declaration because it's a stock dividend that you receive. So that's one thing good about it. And then as we understand from a while ago, taxation is different, right? A stock dividend might be on capital gains compared to ordinary dividends, which will be based on ordinary income, which is on a higher tax bracket compared to capital gains tax. I know there's a lot of things to remember, and then you think about the holding period also on capital gain should be more than a year and things like that. That's why normally when you involve yourself on stocks as a personal investment, you would need to talk about these things with your advisor. Because depending on the strategy you're trying to do, you might have a tax implication. So that's something that you need to flag into things when you think about investing on your own. Now, what is the use of the stock dividends? Basically, in uh, long story short on stock dividends, in case that the company does not have cash, remember our example a while ago, you have 15 million of retained earnings, but you only have 500,000 in cash because everything is tied up somewhere else. Even though you might have access to capital, there's a cost to obtain those capital or to take a loan to declare cash dividends. So why not do a stock dividend? But why would you want to do that? Because you would want to show to your investors that you are actually giving them something back to them, right? Other than the dividends. Of course, it would actually can be seen as, hey, is the company unable to pay dividends or cash dividends? And then do they have inefficiencies in cash flow generation or operating cash flow? So those can actually come up as a discussion, but it can also, between no dividends or no cash dividends and a stock dividend, it's better to have a stock dividend. Or unless you know that you can reinvest it to a project that's actually going to be a higher rate of return, then that might be something that you would want to communicate to your investors during your earnings report. So remember at one time we talk about every quarter, public corporation release an earnings report or there will be an earnings call. So it's the CEO, the CFO, and then they would actually have other people on the call, like people from the analysts at Wall Street, from the investment bank. And then those are brokers who will talk about how good the business is, the state of the economy, or the state of the business with regard to the economy that we're currently in, and things like that. So that discussion would actually may include a stock dividend declaration, or maybe a cash dividend, or a postponement because you are talking about future capital expenditures that you would want to use your earnings and use internal funds to invest on it. Now, we talked about a stock split. If it's actually a dividend, a stock dividend is more than 20 to 25%, right? In excess of. And then the FASB, oops, sorry. I'm going to break down the FASB. The Financial Accounting Standards Board is the accounting regulator that provides some of the pronouncement of the accounting standards, and the New York Stock Exchange. Um, they agree that the accounting for stock split is actually different. In the stock dividend that we discussed a while ago, there is a transfer from retained earnings, right, or a movement or a reallocation. But on a stock split, there is no transfer of funds from retained earnings to the capital accounts. And then there will be now a reduction in the par value. In the stock dividend, there's none. In the stock split, there will be. And then there will be a proportionate increase in the number of outstanding shares. Better to explain it through a diagram or a example. So here, if you have this is a before and after stock split, right? If you have 1 to 2 stock split, if you have 1 share, it's going to be 2 shares, and they're going to give you 2. So the 1 million shares became 2 million. But remember that 1 million shares is actually at 10 par value, because now you increase the number of shares, the 2 million shares, you now reduce the par value to 5 par. So what's the easiest way to understand the stock split? Your common stock would be the same. Remember, on the stock dividend, it increased, right? Because the par value never changed. But on the stock split, the par value actually changed. It became diluted by the proportionate change in the number of shares. So, but the same goes as the baseline. Everything is the same, 30 million, but now compared to also the stock dividends, but now here there is no change on anything anymore. It's the same. It's now the par value getting diluted. So that's the most important thing. This is the major change on a stock split. Okay. So there is also what we call a reverse stock split, a bit different, right? So instead of saying from a 1 to 2, increasing it, you actually have 2 to 1, or say 4 to 1, depending on. There is actually a way why would you want to do that? If you actually want to do control or take control, you basically do a stock split because you're diluting now the number of stocks that are in the market, right? Um, so they might, so basically it's a repurchase of its own shares. A company is repurchasing its own shares as a part of a reverse stock, the reverse stock split. So the earnings per share may increase because the number of share decreases. That's the good thing about um, reducing the number of shares or through a repurchasing. What's the formula for EPS? Is net income divided by the number of shares, right? Now, if you reduce the number of shares, if you have the same earning, it would mean that your EPS is higher. EPS is a key performance indicator for most of those who look at the stocks, one of the many key performance indicator as to the stock's performance. But like EPS is actually being used by a lot of traders as a guide, right? And then of course you need to read the financial statements, knowing that by now we know that there's no one KPI that can represent the entire performance of the company, both on their operating initiative or their financial performance. But math-wise, this is actually where the math happens, right? EPS with a repurchase of stock through and then the EPS would actually be higher because of that repurchase of stock, because your base would actually be smaller, right? And your net income will, just in case your net income is the same.